Stocks swing between strength and weakness after a mixed closing in the US overnight. Energy leads gains while metals sulk, mid-caps underperform.
SBI Card slides on lower margin and revolver rates. Tata Chemicals skids on missing profit expectations. Indus Towers slips on receivable worries, whereas Sun Pharma too sulks after its US arm Taro posts a loss.
Aditya Birla Sun Life AMC loses ground on a lackluster performance. Supreme Petrochem slips after sales and profits dive, but Gokuldas Exports gains on strong revenue and profit growth.
Elon Musk's tweet, "The bird is freed," suggests that he's completed a $44 billion takeover of Twitter. Reports of a big shuffle at the top follow.
Hello and welcome to Halftime Report. I'm Ekta Batra and with me is Mangalam Malu. Well, it's turning out to be a session. It is the end of the week. It is the end of a truncated week and it's a bit of a mixed performance on our hands at this point in time. So we have the Nifty, which is just about higher by around 23 odd points. Consolidating, you'd have to say, with a bit of a positive bias at this point. But it's really the mid-caps and the banks, the financials, which have had an absolutely strong run this week, which are now seeing some amount of profit taking. And case in point would be a lot of the broader market banks. For example, the Bank of India, Union Bank, Canara Bank, PNB, IOB, Bank of Maharashtra, UCO Bank. All of these stocks have rallied anywhere between 5 to 6% to even 8 to 15%. For example, Bank of India on a week-to-date basis has rallied over 10%. So that gives you a sense in terms of the kind of gains we've seen for a lot of the larger segment banks, or rather the broader market banks, as compared to just the frontliners. Hi, Mangalam.
Hi, Ekta. Take your point out there. But for the Nifty, it's another day where levels upwards of 17,800 are proving to be a bit of a resistance. We're virtually at the low point of today's trading session. And the reason why we're holding with a mild positive bias is because it's Reliance versus the rest on the index today. Reliance is virtually at the high point of trade with a gain of almost 2% plus. By virtue of its weight, it is managing to keep the Nifty in the green, but it has been pressured on the lower end by the Nifty Bank, which is down 350 points at the low point. And even some of the metals are, are declining after gaining a little yesterday. So we've seen Tata Steel, which is currently at the low point of trade. IT stocks not doing too well. TechM, for instance, is at the low point of trade as well. So you can call it Reliance versus the rest as far as the frontline index is concerned. But let's talk about some key results. We do have a bunch of them in focus, and a lot of them actually at the lower end as well. Lower in today's trading session is SBI Cards after its net interest margins has disappointed and the revolver rate has declined as well. Abhishek joins in with the details on that and what exactly it implies for their business going forward. Abhishek.
Well, Mangalam, as you mentioned, the revolver rate or the loans which actually become due and starts earning interest for the company has actually reduced from Q1 FY21 levels of 45% to right now about 24% as of Q2 FY23. So what this has meant is that even the yield has declined from 22.8% back in Q1 FY21 to right now about 15.1% in Q2 FY23. This has had the impact on net interest margin as well, which has declined from 19.2% in Q1 FY21 to right now about 12.3% as of Q2 FY23. Credit cost that continues to remain elevated at about 5.6% in terms of annualized credit cost when compared to 5% in the previous quarter. Asset quality has seen some improvement, 10 basis point decline in the gross NPA ratio on a sequential basis. Total income is up 28% YOY and about 5.8% sequentially. They have reported a PAT of about 526 crore. Motilal Oswal Securities was working with a number of 590 crores. So brokerages, they have cut EPS anywhere between 1% to 17% for FY23 and anywhere between 2% to 14% for FY24. Higher than expected credit cost is a negative surprise, and the revolver book decline, which continues, is also negative for the company. So JP Morgan has downgraded the stock to neutral and they have cut their target price by as much as 24%. So the new range of target price from brokerages is as low as rupees 700 per share to as high as 1,175 per share. Back to you.
Okay. All right, Abhishek. Thanks very much for that. So that's on SBI Cards. But I'm just watching Sun Pharma today. It's one of the pharmaceutical stocks that I'm watching today. Dr. Reddys is coming out with numbers, but Sun Pharma is reacting to its US arm, Taro's numbers, which came out late last night. So it is a reaction, as you can see on the screen. And it is a disappointing set of numbers. So, for example, the sales have been absolutely flat on a year-on-year basis, $130.5 million. And it missed street estimates because some were estimating around $160 million in terms of sales this quarter. It is the lowest sales that they've reported in at least 10 quarters. Now, operating loss of around $6.81 million is what they have reported. And on an adjusted basis as well, the margin is at 0%. Net loss as a whole is around $2.8 million for Sun Pharma this time. Now, the company has said that the net sales were lower due to continued price decline, particularly in the US generic business, as well as impacting the operating performance of the company. But what the street is a little worried about is that the revenue picture did not change much despite a recent acquisition that the company made. And in fact, the integration of the acquisition is also one of the reasons why the margins got impacted this quarter. Now, the other thing to note is that Sun will be reporting its numbers on the 1st of November. And now the street is a bit worried on what they could report on margins, because factoring in Taro's operating loss, there could be maybe some amount of downside risk to Sun Pharma's consolidated margins. But remember, they have a strong specialty business in the US, so that could make up for some of the losses. Separately, Taro has $1.2 billion of cash on its books, so that is definitely a cushion to the bad performance this time. But Mangalam, you're watching a stock which we've discussed multiple times as well on the show about Nykaa. Yes, there is more liquidity which is going to come probably in the next couple of days, but fundamentally there seems to be something amiss.
Fundamentally, there seems to be nothing amiss, actually. Interestingly, on Nykaa and all these companies, Nykaa more so as against the other companies because they're the only ones which are profit-making. So that is something that we'll have to watch out for. But just for now, the worries are a couple. One, that, there would be a little more supply coming in November 8th, November 9th, because the company, remember, listed on November 10th, 2021. So it will be the one-year lock-in where, all the equity that was allotted pre-IPO is now allowed to be sold in the open market. Now, as per their red herring prospectus, we had around 47 crore shares or 98.5% of their equity, which was allotted pre-IPO. Promoter holding of the company is currently 52%. Some part of that also is freed up for lock-in. But assuming that promoters aren't looking to rush to the exit door right now, that still leaves about 21.8 crore shares or 46% equity, which is available for supply come November 8th, November 9th. That is something that's spooking the street. What's the other thing that's spooking the street is also that, there has been some incremental selling as soon as the stock declined from below its IPO price of 11.25. Nykaa was one of the only few new age platform stocks which did not, fall below the IPO price when we did see a rout in all the other stocks. So maybe after that happened, a lot of them who would have allotted the shares at the IPO price itself may have looked to, save their losses or stop their losses. The second thing that's, worrying about Nykaa is a couple of these top management changes. Yesterday, there was an appointment of the Chief Technical Officer. We have Rajesh Upalapati, who's joined in from Amazon after having worked in Amazon for 20 years. The worry is, however, that Sanjay Suri, who's been with the company since 2016, has left and has been replaced by Rajesh Upalapati. And before that, we had Reena as well, who left from the company itself. The third thing, maybe the street wants to, stay out of the current storm that is taking place with regards to supply and the uncertainty in global tech companies, etc., and wait for their third quarter numbers. The second quarter's numbers come on November 1, and if deliveries update is something to go by, not much has changed between the first quarter and the second quarter in terms of fundamentals. So maybe the street wants to give it a fresh look only after the third quarter, where there would be a lot of the festive season sales, etc. And that's why maybe, well left is something that the street is doing, and as a result of which we aren't seeing a runaway rally. Instead, we are seeing a sell-off in Nykaa.
Okay, so this commentary from the management would be also very critical when they come out with their numbers next week. And just going by that, it seems like it's going to be a very busy week in terms of a lot of important numbers coming out next week. But let's now focus on our segment on Halftime Report, which is Insight Edge. We have Vahishta, who's joining in to give us her perspective and the Inside Edge on Gokul Das exports. Vahishta, over to you.
Thanks for that, Ekta. Well, first, a little bit on the results. The revenues were up 28%, but remember, this comes in a seasonally weak quarter. The EBITDA margins had also come in a little bit lower at 11.8% versus 13.1% in the same quarter of last year. The company had said that the retail sales in Europe and China is not as great, but the US markets have been quite resilient. The US retail offtake in the first half of the ongoing calendar year is higher than the first half of any of the past years. Also, the export revenues for the company have grown 24% on a year-on-year basis in the past quarter. The company also has a strong cash balance of about 400 crores, of which capex incurred in the first half of the ongoing financial year was 51 crores. While in the second half of the ongoing financial year, they would be incurring 106 crores, and FY24 expectations are higher at 125 crore. The management has also given a guidance for the outlook, wherein they say that Q3 of FY23 is expected to remain more or less flat on a year-on-year basis, but the extended summers and hence the demand for summer products should be reasonably robust. One key thing to watch out is going to be the sentiments during the holiday season, which extends all the way up to Christmas. And US is looking at alternate opportunities for sourcing from India, which is for replacement, and this should be benefiting Gokaldas exports.
All right, Vaishya, thanks a lot for that. In fact, earlier today we did catch up with Shivaramakrishnan Ganpati, who's the MD at Gokaldas Exports, and this is what he said about the company's business outlook going forward.
Quarter 3 is going to be a quarter to watch. Globally, there is a lot of things going on. There are headwinds in Europe, headwinds in US, and headwinds in China as well, where retail sales is not so great. We are building the capacity in anticipation of certain orders. Obviously, if the growth exceeds our expectation, we will not shy away from putting in more capacity.
All right, we take that point on Gokaldas Exports. With that, we'll step into a short break. On the other side, we've put our focus on Gland Pharma. That was one of the stocks which were, most noticeable on the downside in yesterday's trading session. So we'll discuss more on Gland Pharma on the other side. Stay tuned. Welcome back. Just keep an eye out on a couple of stocks. RBL Bank is the one which is in focus. A sharp recovery from the lows is what we're seeing out there. Remember, this morning we did understand that reports suggesting that RBI's likely withdrawal of their official from RBL Bank was inaccurate, and now we'll probably get some more details on that. The state is definitely building something in on RBL Bank, which is why we've seen a sharp recovery from the lows currently at the high point of trade. But let's talk about stocks which tumbled. One which tumbled yesterday was Gland Pharma. It tumbled yesterday and now as well is down by almost 2%. That's because earnings came in well below street expectations. Ekta, take it away.
Yes, absolutely, Mangalam. We spoke about this yesterday as well on the show, that Gland Pharma was a complete disappointment in terms of a reaction as well when it came to its second quarter numbers. And remember, it is, though it reported what was a recovery on a sequential basis. Now, the disappointment this quarter was primarily on the margins. The margin disappointment was led by factors such as a change in geography as well as the product mix, possible inventory write-offs as well as higher competition. Yes, the first half was a miss, and FY23 could be a tough year. But what seems to be worrying the street is the medium-term outlook for the company, the medium-term growth outlook for the company. The company from FY18 to FY22 reported a revenue and EBITDA growth of over 25% CAGR. The street is now skeptical on whether the company can get back to those growth figures. A few challenges, according to analysts, for medium-term growth include delays in addressing product-specific issues, higher competition and slower than anticipated recovery in the India business, and higher operating costs, as well as maybe ironing out of the supply-related challenges that they've been facing. I just want to add that besides the earnings disappointment in the first half, the street has also been worried about the liquidity of the promoter, Fosun Pharma's holding company, Fosun International. So these are a couple of factors to keep in mind for Gland Pharma. We are seeing a little bit of downside in today's trading session as well. To talk more about Gland as well as a lot of the other pharmaceutical stocks, we have Bino P, who's the Director Research at Incred Capital, who joins in now. Bino, hi, welcome to the show. Well, you've been a long-term watcher of Gland now. Tell us, what would your key worry be on Gland, and do you think that it could get back to those 20% plus growth levels and margins of over 30% that it used to enjoy?
Sure, hi. So when thinking about what Gland can deliver going ahead, we have to keep two things in mind. One, if you look back the last 5 years, 5 years back, Gland was operating at a very low base. So growing on that base was a relatively easy thing, whereas the 5 years of growth has put a very high base on Gland, and already a lot of the attractive products in the US they have already launched. So incrementally, the growth rates would be tougher as the base grows. So that is one point to be considered. And probably I would also look at the role the COVID and the associated lockdown played. The COVID and the associated lockdown suddenly created a huge demand for injectable capacities globally, which can sell into the regulated markets. So Gland significantly benefited from this increased demand, sudden increase in demand for injectable capacity. But now with COVID and the lockdowns behind us, a lot of that extra demand or excess demand has dried out of the market. So naturally, the kind of premium pricing they could charge must have suffered quite a bit. So all of these factors need to be put in the right place when looking at the forward growth rates possible. Having said that, there are some growth opportunities which Gland management is pursuing. They're continuing to file and launch more than 20 products a year in the US. They are accelerating their filings in the US, in China. They are actively expanding in other markets outside of India, China, and US. So all this will get Gland to a growth path once their FY23 base settles down. But of course, I would think that it would be a bit lower than what growth rates are used to.
Okay. Just a quick follow-up, Bino, on Gland. If you had to compare Gland's business in terms of injectables to the likes of Aurobindo, as well as even say something like a Dr. Reddy's, how would it stack up?
So Gland, as a strategy, Gland till now has focused on plain vanilla injectables business. Its capability is in very low cost, highly efficient manufacturing and extreme compliance. Till now, Gland has not got even a single warning letter from the US FDA. Whereas if we look at Dr. Reddy's and Aurobindo, it's a more diversified business. Plus, within injectables itself, they focus more on high-value, complex products, especially Dr. Reddy's. So to that extent, the business is slightly different. But of course, now Gland has also started moving in the direction of adding more complex products to its pipeline, because the growth from plain vanilla injectable products may not be as great on the current high base.
Bino, just wanted to understand, that you said that there are a few growth triggers for Gland as well. They are investing for some future growth, potential growth opportunities. The stock has corrected almost 50% from the top. This year itself, it's halved. And in just the last three trading sessions, it's corrected about 15-16 odd percent. At lower levels, when does it become attractive? When do the risks, or rather, when do the opportunities underweigh the risks in the stock?
So there are a few questions around the sustainable level of revenue margins, what the company can do, which we will get more clarity on that as the Q3 and Q4 of this year results come by. From there, we need to understand what's the possible medium-term growth. So if I roughly assume that what we have seen in Q2 is kind of a base level of performance. And assuming that they can deliver a mid-teen sort of growth on top of that year after year over the medium term, I think value has started emerging in the stock at around these prices.
Okay. Bino, I wanted your thoughts on Sun Pharma. Taro has been a bit of a subdued quarter in performance this time, especially in terms of the operations. What is your view?
Sure. So Sun Pharma at a consolidated level is an exceptionally good business. Some parts of it sometimes suffer, some parts of it deliver very well, kind of compensate each other. As a whole entity, Sun Pharma still looks attractive, especially given the way the global specialty business is panning out, still continuing to grow at 20 to 30% rates. Taro has been a disappointment for several quarters now. The quarter that was just reported was even worse. But as long as the rest of the business is doing well and compensating for it, I would keep Taro on the side for the time being.
Okay, all right, Bino, we're going to let you go. I'm sure you have a busy day ahead of you with the Dr. Reddys numbers expected. Thanks very much for joining in and speaking with us. So that is the view coming in on the pharmaceutical space, a couple of key stocks such as Gland as well as Sun Pharma. Well, that is the Tata Chemical con call on your screen. Margin in other geographies like the US and India will sustain. They have said that they have seen elevated gas prices when it comes to Europe, but now maybe there is some amount of respite that is coming through. Well, some more flashes on your screen. We'll do one thing. We'll try and get Sonal in to talk a little more about the Tata Chemical conference call once she does get away from the phone. As of now, we'll take a break. Manish Hathiramani of Deen Dayal Investments will join in with his trading strategies. Stay tuned. Welcome back. Well, there's some interest which is coming into the hospital space. So we have Apollo Hospitals, which is your top gain on the Nifty. That stock is up around 3% odd. Not yet released its Q2 numbers, so do watch out for that particular counter. And separately, even Vardhaman Textiles just about reacting to its numbers. It's been a sharp decline in terms of the profit, down over 50% year-on-year, revenue up around 3.5% on a year-on-year basis. As you can see, the stock is down 3.5%, reacting to what has been quite a sharp decline, both in terms of EBITDA as well as in terms of profitability. EBITDA has come in all the way at around 14.5% odd, sub 15% figure, as compared to 28.4% year-on-year. But let's get talking about the technicals. We have Manish Hathiramani, who's joining in to tell us what he's tracking this Friday. Manish, hi, welcome to the show. Well, it is end of the week, but give us your sense in terms of any stocks that you're confident on rolling over into next week.
Hi, Ekta. Good afternoon, and good afternoon to all our viewers. We've kind of gone sideways. If you look at the markets, we were really excited today in the morning when we started touching levels closer to 17,850. Really, 17,650 to 850 has become a short-term range which we've been stuck in for the last 2-3 days. Having said that, I'm actually working with 2 sell calls for the week and to roll over. The first one is on Hindustan Unilever for a sell target of 2475, stop loss 2600. The stock has been in a downtrend since we broke the supports of 2650. We had a bit of a pullback yesterday, but the stock continues to remain weak and bearish. The second sell is on Tech Mahindra for a target of 1030, stop loss 1075. The stock is facing resistance at higher levels, and we even broke the short-term support of 1075 with higher than average volumes. Both are sell calls from my side.
All right, Manish, thank you so much for joining in and giving us those calls on individual stocks as well as the market in the near-term range right now. But while the market's in a near-term range, we've also kick-started a new series today. It's the November series, as the October series expiry took place yesterday. So let's talk about the F&O setup for the November series as a whole, as against just midday right now. And November series in the past has been known for some events taking place and, big moves on either side. I remember demonetization took place in a November series, and then November 2020, there was this big momentum in the market, and there was an 11% move on the Nifty, one of the best series that we've seen a couple of years ago. November 21 was on the downside by about 320 points. So let's see whether November 22 has similar sort of moves or not. As far as rollovers are concerned, or positions which were open in October, whether they've been carried forward to November or not, this time around 76% of the open positions on the Nifty have been rolled over. That's been lower than the last 3-month average, but 76% is pretty much par for the course. What really stands out is the FII long exposure. At the start of the series, the FIIs are 59% long, and that's a number that we've seen highest in the last many series. And that is where the interesting bit is, because one, we've seen 919 points move in October series already. At the start of the October series, the FIIs were just around 13% long. So, the series rallies are usually rallies of disbelief. In July, at the start of the series, the FIIs were long just around 15%. The Nifty went ahead and rallied 1100 points. Then we had the August series where some conviction built up. The FIs were 57% long, and the Nifty rallied just around 593 points. So not as much as July. The question is that after the big rally in October, will the rally in November sustain or not? FIs are now 59% long. Well, all of that depends on the triggers for November series. What are the triggers? The first one is the remainder of the second quarter results. Then we have the US FOMC meet on November 1 and 2. We have the US midterm elections on November 8. So it'll be more global than local. Global central bank commentary, the actions that they take, and commodity prices. So those are a bunch of things that we'll be tracking, dollar index in particular, to know which way the November series is likely to move and whether momentum from October sustains into November or not. Levels upwards of 17,800 to 18,000 could be a bit of a resistance zone.
Okay, all right. So that's the resistance zone up to 18,000 is what we could probably expect in this series. Thanks, Mangalam, for putting all of that into perspective. We need to take a short break, but up next, we will put the focus on one particular company. We have Vishwas Patel, who's the Executive Director at Infibeam Avenue, as the Reserve Bank of India has granted in-principle authorization to operate as a payment aggregator. More on that once we're back. Stay tuned.
Welcome back. The stock on our radar is Infibeam Avenue. It's not usually spoken about, but currently is locked at the 20% upper circuit, and that's because it's received an in-principle nod from the Reserve Bank for payment aggregators license. What does this mean for the company, and what the business prospects does it open up for them? We have Vishwas Patel, who's the Executive Director at the company, joining us now. Thanks a lot, Vishwas, for joining in. First up, just wanted to understand how many companies apply for this license, how many of them get it, and once you get it, what does it do to your business? What's the opportunity that it opens up for you?
So whatever I hear from the press, more than 150 plus companies did apply. And what has also come out in the press is that only 6 or 8 have got this license till now. What this helps is that today in the payments business, today as a company, we can go across in the hinterland and deploy payment infrastructure, payment systems, accept online and offline merchants, and this comes under the RBI purview now with this license. So it's a very coveted license, and what it helps the company is that today, if you see overall, India, there's been too many growth enablers right now in the technology sector. There are 700 million internet users, 600 million smartphones, and they're the highest consuming data consuming nature in the world. 150 million shoppers in this thing, but the acquiring base, the merchant acquiring base today in the hinterland is still not there.
We have the macro data. We have the macro data about the potential in India. What we wanted to understand is that your recent launch, Tap Pay for Merchants, is that also RBI approved? Is it going to replace the traditional POS machines? And how much incremental business can this aggregator license that you've gotten from the RBI bring you?
Yes, the tap pay that you just mentioned, it helps, it's a transformational technology that anybody with a simple Android phone can turn it into a POS terminal, and any merchant across the country can start accepting payments. So it's a transformative to that whole bulky $200 POS terminal to a simple app download on a phone and convert it into a POS terminal. So the penetration that can go into the hinterland wherever there is a 4G, 5G connectivity across the country, it enables even the smallest of merchants, a street vendor, to accept all types of payment options, credit card, debit card, not just a QR code with UPI payments, but it also enables them to start taking credit card, debit card by just tapping on the phone. So the TapPay solution is India's first pin-on-glass certified solution, and this can really help accelerate the acceptance networks in the country. And that's why this license is a very important thing for the company to give all the power to acquire merchants across the country to transform so many sectors. Say education itself, like 1 million schools in 4 states are not accepting it. So anybody can start accepting it. Tuition teachers can start accepting it. The smallest food cart in Northeast, in a village in the Northeast, can start accepting it. So it's a very transformative, and this license will surely help give a lot more power and legitimacy to grow this acceptance base in our country.
Okay.
Mangalam.
Can you give us a sense in terms of what is the eventual platform that you want to provide? Because now that you have tap pay, plus you've been approved by the RBI when it comes to being a payment aggregator, you're probably looking into entering other verticals as well, say into working capital and invoice discounting, if I'm not mistaken.
Yes, so what happens is that...
Just give us what are the other ancillary services that you've applied to for when it comes to the Reserve Bank of India, and what can we expect when it comes to a platform of services which you would be providing?
Sure thing, Ekta. What this helps is that once you have a license to do the payments part, you add your platforms, which we are known to do platforms for multiple businesses. We do the entire platform for the government e-marketplace GEM, which does around 1 lakh crore a year. We also have so many platforms for smaller merchants, for bill payments and other things. So putting platforms and payments across the country, making it easier for the merchants to do online. And once we start empowering the smaller merchants in these villages and towns, these merchants become bankable, credible. So what happens is that then the credit finance, because India is credit stuffed today. If you see the overall 47% of the credit inflow is still through informal channels. So once these merchants start accepting online payments and become part of the formal economy, all these other value-added services down to the hinterland will go in. Today, banks are just serving the overserved, right? The underserved, which are there where there is a massive credit uptake and requirement. That's where once this first part of the payments is sorted, then the credit will also flow.
Right. We take your point, Vishwas. Just wanted to understand from a business standpoint, understanding Infibeam's business, you have 3 verticals. There's the payment stack, which has CC avenues, etc. Then you have the platform stack. And then the third one is the credit stack that you have. What exactly is the revenue breakup that you generate from all these 3 verticals? What are the blended take rates for the company? And at the same time, for these 3 verticals, say, what is the take rate for payment? What is the take rate for platform? What is the take rate for credit? If you could give us these numbers.
Mangalam, we are right now in a silent period, and I think our Q2 board results are announced on 4th of November. So won't be able to give much info into this, but on the past, what we have already announced, that is this right now. So our take rates in a payment business, which is almost 80% from a platform, 20% is a platform business. The take rate is increasing quarter on quarter. Today, right now, it's around 6.9 bips, and it's growing right now. There is also as more merchants and more transactions, we're already given guidance of doing around $100 billion of processing volume across our platform and payment business, and that's growing very, very fast. And it will keep increasing more and more once we have got out of this COVID period, and more other businesses are coming online, are coming back to perform, like travel, entertainment, hospitality, and many others which were down during the COVID period. The take rates and other things are definitely definitely we already given a positive guidelines. We already announced that we are on $100 billion run rate by 2024. So those take rates and the volumes will keep increasing as we add more and more merchants, as we keep building more and more innovative solutions to go across. And now with this license being very constraining the players, that anybody cannot just come into the country and start operating without this knot. So it gives us that additional power, empowerment from the RBI to actually go out and mass deploy in a very safe and in a very growth-oriented manner.
Okay, so you are positive about your net take rate rising despite competition increasing in this space? And is it probably, I know you have your silent period on, but is the pace of the take rate going to rise as much as we've seen, say, coming in from FY22 to Q1 FY23? You probably closed at around 5.2. In Q1 FY23, it jumped to 6.9. So will that pace continue, or will there be some kind of stability or deceleration? Any guidance in terms of the pace?
Yes, those take rates are going to. I just told you during COVID, most of our major verticals like airlines, hospitality, the entire OTA business, and entire the entertainment business of cinemas, everything was down, right? And those are the big percentage block, because travel accounts for 42% of the overall e-commerce. Those all were down during COVID period. So now those are coming back on stream. We power close to 3,000 hotels in the country. We do more than 20 plus airlines. All those, once those businesses start coming in and start performing more with the holiday season now coming in, this thing, definitely we expect a better take rate and other things. We already given guidance in our last Q1 results. Let's see after the Q2 results.
Yeah, so just for the viewers, information, we'll reiterate that guidance. You are targeting 16 to 1700 crore revenue this year, with EBITDA of 170 to 190 odd crores and net profit of 110 to 125 odd crores as well. Just a couple of questions before we let you go. What's the kind of float that you generate with the kind of volume that you trade? I mean, do you get to keep the money for a shorter period of time for yourself before you pass it on? Are there any returns that you generate on it?
The float business, no, we don't look that as an income.
Okay.
Keep it with the RBI. It's a RBI monitored nodal account, and we don't make money on that float. But anyway, it's a T+1 to T+3 settlement, and that's not the core focus area of the company to make interest out of that rolling money. But our major option is in processing volumes and providing platforms and charging them for the platforms, and then credit. So credit is the major focus now.
Right.
Which we have.
So float is not your core business. And finally, from a shareholder perspective, two things that really stand out. Promoter holding at 30% is low. It has declined over the last few quarters as well. Are you looking to increase the stake in the company? Secondly, I mean, not repeating what took place in the past. In 2018, there was an auditor issue, etc. But what that did is it took away all your institutional shareholding. So, these two are red flags for investors looking at your company. Promoter shareholding low and decreasing, and no institutions, no notable domestic institutions holding stake in the company. What are you doing to fix that?
So I can't comment on the individual institutions coming in, because I don't look at the share market. We are here to perform, to build a very large, profitable company. That's always been the focus of ours right now. Even if you have seen the last announcement during the last Q1, I personally are putting in my personal money into subscribing into the warrants of the company, because we are positive about the company that is there. So having said that, past being the past, right now, if you've seen people who understand this business, it's all bank to bank to bank. The GEM numbers that we process for the government marketplace of more than 1 lakh is visible on the GEM website. Anybody who knows article, I personally am the chairman of the Payments Council of India. We've been doing profitable, consistent growth business from last 22 years for me, at least in the CC Avenue payment gateway space, and never had any kind of this thing, from any card companies. We are very reputed, and the growth prospect that we have and what we do is quite visible to all the investing audience there.
Okay. All right, Mr. Patel. We're going to leave it on that note. Thanks very much for joining in and speaking with us. So that's Infibeam. The stock is up around 20% today on the back of that payment aggregator news and the Reserve Bank of India giving a go-ahead to the company for payment aggregation. So that stock is performing on account of that. Huge volumes, around 30 times its average volumes is what it's done in today's trading session. Take a break. But before we do that, here's some great news for investors. You can now track the US market real-time action on money control. Just log on to the website or the app and stay informed about all that matters in the global markets. We'll be back after a short break. Welcome back. Well, giving Nykaa company today is also Zomato. So that stock is down around 3.3%. Don't lose sight of the kind of performance that we're seeing for Zomato in terms of volumes as well. Remember, both Nykaa as well as Zomato have lost over 50% of their market cap this year. So important to note the kind of performance that we're seeing on these counters. Separately, it is a couple of other result reactions which stand out. So for example, SBI Card, we've been talking about that. That stock is down around 5.5%. And interestingly, Tata Chemicals has now moved to the low point of the day. So Tata Chemicals is now down close to 5% at this point. So just watch out for that particular stock. Also, a couple of stocks such as Lemon Tree Hotels is seeing a bit of profit booking at this point. So that stock is down around 3%. On the upside, like I had mentioned, there are a couple of the hospital stocks which are doing well. So we had mentioned Apollo Hospitals from the Nifty space. And then there's Narayana Health, which is doing well as well. So that stock is holding with a gain of around 7.5%. Time for a break. But on the other side, Manisha Gupta, commodities editor, will be with us. Stay tuned.
6%, Dogecoin, stablecoin, all of them have seen very sharp declines. Today is a stronger day, and the big point being that we have seen the overall crypto global capitalization go back above $1 trillion, and this is ahead of the US Fed meeting, where the markets do believe that the 75 basis points has been factored in. The US GDP numbers came in on a stronger side as well, and as other markets seem to be stabilizing, is the case with many of these cryptocurrencies as well. So nearly 20,000 holding for Bitcoin. Ethereum is trading above 1,500. So we have seen good gains coming in for this one as well, especially in last 1 week. Ajit Khurana is founder at Reflexical, and he joins us on the show now to throw some more light on that. Ajit, hi. Welcome to the show. First of all, on the crypto prices itself, and we've been talking on how it continues to move as other asset classes. How are you looking at the current price readings?
So I think that crypto is very surprisingly to many of us behaving exactly like the equity markets. It is driven by the liquidity or lack thereof. And we hope that mid-bear market, there would be a resurgence in price from the 20,000 levels. But I think we are a few quarters away from that.
Ajit, how have you seen this latest report from OECD suggesting that there should be a reporting framework that has been created, or that what they have suggested in sense of cryptocurrencies as well? As of now, it's not included in any reporting framework. Now this one being created for digital assets, how will that improve situation?
What has happened is that in most territories, it is individuals who are participating in the market, and institutions, larger family offices and the kinds are staying away. With more regulatory clarity, such as the reporting standards, I think it will bring larger amounts of money in, and that can only be good for the market.
We also have seen crypto and Web 3.0 adoptions continue. I mean, even as the NFT sales haven't done so well in the third quarter, but you have the names such as Reddit and Starbucks and Google all take some elements of Web 3.0 and start using it within their strategies, within their marketing and branding as well. How do you look at these big names actually adopting the new technology?
When we started out on the crypto journey, it was all about give it to the man, and the big names and the centralized systems should not exist. Today, however, the large centralized systems are adopting some version of crypto like you, or Web3 like you rightly said. So it's no longer about black and white, but shades of gray. I think that the largest adoptions will come when larger players such as the ones you listed and other players such as banks, etc., create some version of Web3 which fits into their way of thinking, yet adopt some positive elements from Web3.
The other trend, Ajit, that I want to put forth is about the NFT sales. For the third quarter, we've seen a 60% decline onto this one as well. The traditional NFT sales perhaps have done better, but the Sotheby's or the bigger names clearly haven't had such a great year as they did last year here. How are you looking at the overall NFT market now globally?
The three reasons why people buy NFTs are: one, because they want to affiliate with a brand or a celebrity; two, because they want some utility from the NFT; and three, because they want price appreciation, which is speculative gains. It so turns out that the last one, which is speculative gains, accounted for most of the market. And as we have gone into a bear market, speculators have gone away from NFTs, which are in any case much tougher to liquidate than the usual fungible tokens. And that accounts for the sale decline. I think that we are going to have to wait all the way up to the next bull market to see a change in this phenomenon.
All right. You know, on our conversation up till now, it really seems like a mixed bag. But what is definitely showing a downtrend has been the prices in this year. So year to date, Bitcoin is down 56%, Ethereum is down 59%, Solana is down 82%, Cardano down 70%. I could just about go on because these are double-digit percentage declines that we've seen in many of these cryptocurrencies. How would you look back at 2022 as we are, and what do you think would be the new things to watch out for when you look at digital assets, cryptocurrencies, or Web 3.0, as everybody seems to be calling it now?
So Bitcoin has in the past retraced 85% of its value on 3 occasions. So from those of us who have been around for many years, this is not as much of a carnage as we are used to in previous situations. Having said that, what will drive Web3? If you look at the 2021-22 bull market, it was driven by projects coming and saying, hey, there is 1 million or 2 people doing Web 3.0. Let us give them services. I think that was not the right strategy because 1 million or 2 is nothing compared to the billions who are on digital media. The next wave will come only when business plans are trying to bring in new people rather than serving the very microscopic market that exists.
And what about the prices? I mean, as you said, it has been thrice in the history that we've seen the markets come back. This time it's taking longer. I mean, the crypto winter, as many of us, spoke about, which has been on for last 6 or 9 months now. Do you see it getting over? Because there are so many reports suggesting that there is accumulation finally happening.
I think that accumulation can, as has been seen in the past, happen for more than a year, maybe all the way up to 2 years. So I do see that, and in crypto, it is very easy to figure out if accumulation is happening or not by looking at wallet behavior. Even though people might be anonymous, but wallets are completely open and transparent. So yes, accumulation is happening. People are doing dollar cost averaging. People are starting to do allocations. Despite all of that, I feel that any resurgence or significance uptick is a few quarters away.
All right. Thanks a lot, Manisha, as well as Ajit, for joining in and giving us the view on cryptos, etc. Ajit said that crypto is behaving like equity. It seems like equity is suddenly behaving like crypto because we've seen a bit of a downtick on the Nifty from the highs this morning, now virtually at the low point of trade, virtually in the red, sitting in the green by virtue of just about 8 points. So we'll watch that as even as the mid caps and the Nifty Bank are at the low point of trade. Take a short break, come back, business lunch. We'll take all the market action ahead.